All right,
Yes.
welcome to this episode of Soundcheck, episode
Soundcheck.
of Real Estate Chat with
Robert Eid.
and John Perez. We gave you a few days to digest the news, and so we could also enjoy a little bit of summer. And so a lot has transpired over the past week. We're going to find out how close Robert came with his forecasts in terms of the June sales and price figures. We're going to read a couple of news items. I mean, we're not going to read the entire articles, of course, that's for you to do. We'll share the headlines with you, but whenever there's a release of the Toronto Regional Real Estate Board stats, there typically follows the media's spin on it. And so we want to debunk some of the translations that have transpired as a result of that. We're going to go to an RBC Economics report that Robert here has shared with me, and we're going to look at Robert's charts. Let's start with the headlines. Actually, you know what? Let's start with the RBC report here, because it's saying that the housing market momentum diverges across Canada. So basically going through this, depending on where you are looking at resales and new listings, you're seeing a very different picture, if you will, of the different aspects of this market, depending on where you are. So in Toronto, you're seeing home resales pop up, new listings dipping. I mean, of course, we're going to update you with the June figures to show that. Montreal dipping in resales and new listings. Meanwhile, in some places in BC, you're seeing a pop in resales and just a tad bit increase in new listings. Robert, what did you glean from this report here?
Well, that there's no such thing as a Canadian market, that the divergence is because each one of these markets is different for different reasons at different times. So Calgary is doing great. You could have put that as a headline.
Now we're going to link this in our show notes, but basically, you know, we see so many quotes about the average in Canada, or you know, one brush doesn't paint the entire picture, right? And that's
well, it can't because it's like plants. You put a different one in the sun than you do in the shade, and it's not the average. You just can't do that.
Exactly. And so now let's digest or dissect what the Toronto market looks like. If you recall in our last episode, watch the previous one, make sure you like and subscribe. Robert goes through an estimate or a forecast in terms of where prices and units are headed. But we also looked at why there's a shortage of inventory. And I think this is one of the most skewed and misunderstood dynamics of the marketplace right now. So I'm going to share my screen here using my little news reader here. And there's three articles we're going to dissect. One is about the Toronto housing market slipping as a Bank of Canada decision looms. So we're going to talk about why sales typically do dip in June, and if this is a natural occurrence, or if this is a, you know, as this person wrote in the Financial Post, is it the result of the interest rate hikes? We're going to talk about the inventories. Unable to downsize, more seniors are living in larger homes. So why isn't there a lot of new listings for resale homes being listed on the market? And we're going to be talking about, has Toronto's housing rebound already peaked? So talking about June figures, rate hikes, and cause for concerns. Let's start with this one here. So this article, Toronto housing market slips as Bank of Canada decision looms. We're going to link all of these two in the show notes. But in a nutshell, basically, they talk about the fact that the sales dip that happened in June is the result of the increase in the Bank of Canada's interest rates and the anticipated increases. And so the media and everybody else who reverberates that same message is basically saying that this increase in interest rates is resulting in the market slipping. And we're going to look at Robert's charts momentarily. But Robert, June sales, typically, what happens to June sales relative to May sales?
They calm down because people buy houses based on the weather and the school year. So June is the entry into the summer doldrums, when if you haven't bought a place for the start of school in September, like, it's too late to do that. You should have done it the month before, unless you're buying a townhouse or something or other where you're getting out of your apartment rental, whatever. You know, July the 15th is the cutoff. Now you're summer and we're into the buying for the fall before the snow flies. So that's why June is softer traditionally than May, April.
And you're going to see that on a chart that year after year after year after year, Robert's chart shows years and years upon this. It's not a surprise for June June sales to drop. We're going to talk about inventory. That's just a separate story. June sales drop almost predictably year after year, unless it's an anomaly year, because of what Robert has just explained. So for an article in the newspaper to brilliantly associate that with an interest rate hike, well, I mean, you could associate that with anything, right? The summer season and everything else Robert has talked about. But there you go. May to June sales typically drop year to year to year. Now let's look at the next article, which talks about the inventory or lack thereof. So this article from the Globe and Mail, unable to downsize, more seniors are living in larger homes with empty bedrooms. And let's look at this, situation, right? So Robert, if you are in the situation where, let's say, for example, kids have moved out of the home, and some of our viewers here who have liked and subscribed to our channel are in situations where, like, I guess they call it empty nesters, or there's a whole bunch of different terminology for this. But then you're looking at selling your home and what it gets on the market versus what you then have to buy. Let's say you're selling a detached home, wanting to move into a condo. You want to get a 2-bedroom condo, maybe a 3-bedroom if they still have those, maybe the older ones. Then you have to pay maintenance fees and all that sort of stuff. Why doesn't this move make sense for some people?
Well, this is a time of uncertainty, and financial uncertainty and mortgage rate uncertainty and monthly payment uncertainty. So that if you are, let's say, 62 and a half years old, and your wife is 60 years old, and you got this big house, where are you going to go to? You're too young to go to a senior's place. And if you want to go to a house that's in a cheaper market and put some money in your pocket, you got to go far, 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 far away from the kids and the grandkids, and they're all still happening. You don't want to do that. And if you bought another house somewhere nearby, even if it was slightly less, you'd be paying almost, well, you're not paying the same money, but the net, what you get for yours and what you pay for that smaller one, it doesn't make sense to move. And so if it doesn't make sense, you don't move. And then if for some reason you're a different person who's got a house to buy and you're going to pay more, you've got to move your mortgage at 1.94% and get more at 5 point something or other percent on a blend, extend, or whatever you want to do. And you also got to qualify. So if there's been any kind of a burp in your income over COVID or anything like that, you don't want to be turned down. You definitely don't want to be turned down. So the whole mortgage qualification stress is enhanced. Normally you'd say, oh yeah, I'll get a mortgage. And the uncertainty of all those three things, where, why, and when, and then the stress test, people aren't selling.
So if you made this move, I guess, pre-pandemic or just before that big bump in the pandemic, that made sense because you sold your home at a decent price, bought something. Let's say if you did decide to go out of the GTA area, you were able to get something pretty affordable. But now there isn't much of a big price difference. But that's the reason why there's so many real estate critics, if you will. We're talking about this big bust in the market because all the baby boomers, once they retire, they're all going to offload their houses into the market. It's going to create a flood of inventory. And, knock on wood, so far that has not happened yet for many reasons. I mean, for many reasons, as Robert has described, some homes are going into the hands of the next generation, the kids of the baby boomers. Yeah, Robert.
And 85 is the new 65. Grandma not selling until she's 85. So those houses are staying in inventory of the existing owner for much longer, and hiring a gardener and hiring a this and hiring a that.
What's the maintenance fee on a condo? 2-bedroom condo, 600, 800, depending on how big per month.
Easy, more like 8 if it's all in, yeah. And then the taxes
exactly. And inflation and
now you're in a shrunk space and you got to move on top of it, and they won't take your cat. So like,
you pay somebody $50 a week to mow your lawn. You pay somebody to landscape, to do all the, and that's the reason why. If you live in a bungalow right now, it's appreciated in value. You're going to sell that, move into a condo. I mean, versus you pay for somebody to take care of your stuff. So that's the reason why. There's one of the many reasons actually. So one of the reasons why there is not as much inventory in the market right now, and that's causing a strain on prices as well, right? I mean, affordability, of course, gets affected in spite of the drop in sales that the Financial Post has said is related to this interest rate hike. Prices are being held because of the fact that there's an inventory challenge. And now let's look at the third article that we wanted to talk about here, is that has Toronto's housing rebound, this is from today, has Toronto's housing rebound already peaked? June figures, rate hikes are cause for concern. And, we're going to talk about June figures. We're going to talk about how close Robert has gotten in terms of his forecast. But, is this really a cause for concern? You know what? Why don't we answer that by going through these charts and graphs that Robert has put together over the past couple of days. We're going to answer that question. Is the housing market right now a cause for concern? Let's start with this one here, Robert.
Okay, well, this is regular sales. It's got far too many numbers on there, far too many lines, because it's got all the years going back to 2006. But what it does is show a big pattern. And the boldest red line with the big stars is the year we're in now. And what I've been using for a benchmark is, how does this compare to the other months of the same in the year? So we're in the 20th best June of 28, because they started in 1996. So as you can see, it's far below the dotted line in the middle, which is the average for the last 10 years. And we've been as good as I think the 15th or something or other best, 14th best May for the whole year. So we're in a very, I won't say lousy, a very below average year.
So it's not lousy, not bad, not
it's below average.
I mean, it is below average. I mean, in terms of sales activity, and you'd expect in terms of what's happening with the real estate market and the dynamics, that of course there would be cause for concern if there's an affordability issue preventing people from buying and thus resulting in a slump in terms of sales. But we've also had previous years of stellar sales, right? And so let's look at here showing the price points where things are selling at in order to be able to discern where in fact the average price falls in terms of what's being reported.
Okay, the last point on the previous chart is, if you look at what we've characterized each one of these months, it was the 22nd best February, the 20th best March, the 20th best April, the 15th, 14th best May, and now the 20th best June. Guess what? This is the 20th best year, except for when it was a little bit better. So everything is compared to what? It's not that the sky is falling. If the sky is falling, it's much better. I can hardly wait for the sky to be falling, because that's terrible. This is just lower volume, but everything else the same. So going on to the second chart, there was a fella, he was actually our company lawyer, Mitch Corman, who said, well, the reason the prices are going down is because there's no $5 million houses. So the board only stops at 2 million, saying up and over. So we can see that there was a peak a couple of years ago, and now it's working its way back up to where the share of over $2 million is 8%. And before it used to be less, but the average price was, lower. And so it should be a little bit higher, not as much as it was, but there are many more $2 million houses that exist, and many more $2 million are being sold this year. So, okay, so here's the same sales number, except done in my school year, meaning that the school year starts in September and ends in August. And in this case, the green bold with the big stars is the year that we're in now, and it's following the same pattern. So it's below average up in this orangey thing in the corner. June was 32% off a hot market. And the recent example of that was in 2021, where there's 11,000, 13 to 21% off the 5 and 10 year average. So it's the same. This is the month that was the 14th best. It's the same below average year. So nothing to be alarmed with. Nothing has changed. June is not the same as May. You cannot seasonally adjust sales. You cannot seasonally adjust prices.
And you can allude to the fact that it was because of interest rates rising that have caused this dip in sales. Certainly, it is one factor. So we're not going to say Financial Post is entirely wrong about that. But what was the result of June sales dipping from May last year, and the year before that, and the year before that, and the year before that?
You got the point there. The reason we have 20th best year is because of the interest rates hikes. We were having a boom because we had 0% interest, which
exactly. You have to factor
now that we've got rates different than that, the adjustment is causing buyers to be reluctant, sellers to be reluctant, and so we have a smaller market.
There you go, pinpointing it to just a 1 month change versus looking at big picture. That's what they failed to do. And that's what we've got to realize, is that this wasn't because of just this 1 month. You're looking at the overall year over year sales figures. And so let's look at it from this perspective. Remember that Robert does these forecasts closer to the last days of the month in order for us to be able to arrive at some figures. So he came pretty close in terms of, you were guessing 1.2, which would actually have been above the May, but the historical pattern proved itself correct. So what are we sitting at here, Robert?
Well, we are now at the highest price that's ever been achieved in the month of June in the history of the Toronto Real Estate Board reporting.
That's ever.
Yeah. That's why it's at the top of the chart. Now, there was a few months last year that were all higher, and there was last month was higher. Okay, so again, you don't compare, you compare what you see on the chart and nothing else. So we made a big deal when the price broke through to the negative last year, but now it's broke through to the positive, which is really saying that last year fell down faster than it was expecting to, and today is maintaining itself in a regular pattern the way it should.
And what you're going to see over the next couple of months, because remember, this is where last year there was a huge dip in terms of the prices going into the summer months. So depending on where we land in prices, and Robert, correct me if I'm wrong, but I don't foresee a dip in prices coming up, aside from maybe slight over, just the seasonal usual price movements. But then there's going to be comparison in media. Maybe some realtors are going to make this comparison about big price jumps from the year over year figure. Is it right to compare on a year over year figure when we're looking at these entire patterns, or will that hype things up? What do you see happening there?
Again, is it normal? If it's normal, then say whatever you want. I mean, you get egg on your face or you'll be prescient. In this case, we can expect the summer prices to be less than they were in the spring. Whoa. And we can expect it to be lower in December, January, because it's the mix of properties and buyers and sellers.
No surprise there. So just be careful of the year over year comparisons that are going to be put out there. Maybe the media is going to put it, but they usually look for the bad news. So they're probably not going to show a huge jump in terms of the year over prices. But some realtors will probably be publishing that. But you got to be careful about how you read that information. As Robert said earlier, look at the chart, and this is what you're going off of. Now let's have a look again at the school year point of view.
School year, which shows exactly the same thing as what we were, of a little bit less than last month, the best for June, but of course there was higher months last year. So if we skip quick to the next one, it's the same thing except taking out that boom year. And so if that boom year of late 21 and early 22 did not exist, this is what you'd see. And everyone would say, oh, look at this year. It's perfectly normal. It's better than the year before, and it's better than it was, and it's following the pattern. So that's the purpose of this delete chart. Now, the interesting thing also is that 416 and 905 have diverged. That the average price in the city of Toronto 416 actually went down by 0.05, not appreciably, but 0.05, whereas the average price in the rest of 905 went up 5%. So now it's 4% advantage to the 905 price-wise. And we can look at it, which we have, but we won't right now, by type, by detached, by semi, by link, by condo. And we'll see that by type, 416 is still higher in every degree, every category. But when you lump them all together, which is what they do, and so breaking it apart, we see that 905 is, and again, that's a huge area, north, south, east, west.
What's your reasoning, or what's your thought for that? Aside from the fact that 905, of course, had pretty affordable pricing relative to city of Toronto, but we're talking about average prices here now being above the city of Toronto. What's the reason for that growth?
Well, it compared to last year. Now, last year was a down year more in 905 than it was in 416. So for us to be steady and them to be up is just the reverse of that. There was Toronto was too expensive, so everybody went to 905. Then it flopped because of interest rates, and so the pressure on specs and on people who couldn't afford it more felt in 905, where in 416, fewer people sold, fewer people had bought a big mortgage, fewer people, blah, blah, blah. So the effect was less. And so this is the reverse of it.
All right.
Okay, so this is just showing the two prices separating. So it goes up and down, and there's a tiny little difference now, 4%. And the news going back, if you care to, is there was a huge run up in 905 in 21. And so guess what goes up must come down. And it's all radiating. It's like ripples radiating from the center and then unradiating, if that's
going back to the mean, or going back to the average price.
Default to, yeah.
So.
Okay, so this is sales, and we see that both of them are off by one's nearly 18 and one's nearly 23. So that's what we're seeing for the whole. There's always about 60% of the sales are in 905. It's just more territory and more people turning over, and so that's the ratio, and it's always the same. So compared to the 10-year. Okay, so the next phase that we'll look at is inflation. And we hear great stories in the United States, great stories in Canada about inflation fading. It's now year over year, only 3 point something or other, except that 3 point something or other is on top of last year's 8%, which is on top of the previous year's 5%. So this shows you the cumulative effect since 2018. The CPI, which is the most modest measure of annual dollar devaluation. The Bank of Canada site now says on its site dollar devaluation as well as price increase, 18% in 1, 2, 3, 4, 5 years, and most of it happened in 21. So there's our real inflation. We're still 17% of both since the last time you checked your checking account, and that's where you're feeling everything at the gas pump and at the grocery store and at the lumber store and everywhere.
So again, this discussion came from a news item that came out that, inflation has dropped, but that's the rate of inflation growth has dropped, but the cumulative effect, you're not buying cheaper bread. Things are still expensive out there.
Right. So here's the throwing it onto our 30-year chart. And we're still way up from where we were a long time ago. The last dip was way up. And it fell off a bit, average from the peak. Well, we all know all this. The only thing that this shows us, and where the yellow splotches are, is when the Bank of Canada or the government of Canada decides as a policy maneuver that inflation is out of control, we're going to wrestle it to the ground with interest rate rises, which affects real estate, yes, but it affects every business that borrows money. So what it does is knock the stuffing out of it. And whether that's the only thing that can be done is another question for another day. So here's where we see the exact numbers that we were talking about, that the price last month went down 1.17%, which is, normal if we look at all the Junes, but that's not what this was intended to do. This was intended to do a look into the future. What if prices change at a consistent falling 1%? So we were surprised. You can see the bold underline where it went up 5%, it went up 1%, it went up 4%, it went up 3.71% in the rally that we had this spring. And why did we have that rally? There's the $64 million question. We had the rally because people thought the pause meant interest rates were over and that they could buy now because prices would be softer and it'd be, it would be a buyer's market. Unfortunately, it wasn't a buyer's market because there was no inventory. So this is where we have all of our past markets put together, and I think we've been confounded by this. The red line is the year we're currently in, and it's dipped back down. We're 90% of what the previous peak was. So coming off 10%, is that terrible? Not compared to the other years, it's not. Okay, so inventory. Inventory is creeping up. We looked at this in our what's going to happen when the TREB results come out. And so the actual result now is 14.1, which is 19% off the 10-year average, and it's 14% off the 5-year average. That's the red line dotted, and the dash is up there. So it's trending up. It's trending up, and we'll watch it as a percentage of sales, because as sales go down and inventory goes up, now your number of months, divide one into the other, barometer also changes.
We'll try to do a mid-month update here as we get closer to the halfway point. Sure. We're going to see what sales and what inventories are looking at.
Okay, so this is our, what is really going on? And something has corrected in the Toronto Real Estate Board's algorithm. There was 3,300 relists in their official relist comparison share study that comes out, but then they hide in the back page, which is, way more than the 1,700, 1,800 that they were reporting earlier. Now the number of inventory went up. It's 21% share. I calculate it as a 26%, 2685 share of the net number, which means a lot of these are duplicates, that when we're seeing new listings, they're duplicates. We won't go on about that. But now it comes out much closer. If we do our old formula, what was the inventory when we started the month? We take away the number that were relisted, and we take away the number that were sold, and we take away the terminates that were not relisted, we come up with 14,000, which is very close, only out by 200 of what our calculation is. So I think they have started measuring the relists differently, or else the nature of the relist is so egregious that they can't call them anything other than a new listing. Okay, so here we look at new listings and net new listings. And we see in the red line, which is the adjusted, taking the do-overs away, that it's dipped down, whereas the number of, in the blue, is going up. And so they're saying, oh, we're getting very close to the average for new listings, but it's not. It's not. It's really, we're off by 25% from what the normal should be because of all these do-overs. So
And this is significant to note, because if again, coming from the media and their interpretation of this data, if they just relied on the number of new listings hitting the market, it tells you one story. But if you're looking at the true story, which behind the scenes we know in the trenches is actually happening, and this is why it's such a misleading figure. The fact is inventory is dipping. New inventory being introduced to the market is dipping. But again, time will tell in terms of what's going to happen in July.
So the other way that same thing is measured by days on the market. Property days on the market is really add together all of the listings on that property and say how many days it was. Now they're still very short. 14 days for something that's a new listing, and you add all the iterations together, it's 19, which means I put it on for $1 million hoping to get 1.2. And I don't get any offers on offer day. And so I put it through again at 1,250. And I get an offer on it and it sells a week later. So you add them together, it's 19 days.
So somebody selling their home, this is still not a bad thing. I mean, you list and you need to move. Property days on market is, again, cumulative, as Robert said. So in the worst case scenario, my first offer attempt getting at the bidding happening on my listing drops, or sorry, it doesn't happen. I drop that listing, I put a new listing up, and it's still sold within 20 days on average.
That's right.
I mean,
well, it's so resilient. Here you can see the average is like 21 days. So it's always good. You've got such power of the seller's market here that you cannot make a mistake. Even no matter how much of a bonehead you are, how badly you do it, you can't make a mistake because you can just do it again.
Exactly.
Okay. Okay, so here we go. Sales to new listing ratio, which is what everybody looks at by taking the new listings as published by the Real Estate Board and dividing that by the number of sales. And so if we look at the red number, or the red scale, that suggests that 47% of the new listings were absorbed as sales, and the dividing line is 45%. So that's right in the edge of buyer's market. But if you subtract the do-overs, you realize that your listings were lower, your sales are the same. So actually you're at 60%, which is right smack in the middle of this 45 to 65, but still tending towards the seller's market. And you ask any real estate practitioner registrant that how's the market right now, because they've got 3 buyers that want to buy something, say there's nothing for sale. And so that's the condition of a seller's market. That's the condition of a hot market.
Yeah, so basically eliminate the drama, right? So when you read the newspapers, it's full of drama. The truth is, and you gotta wonder, despite of what's happening, home prices steady, if not rising, interest rates going up, inventory tight. Where's the market crash? Right? Where's the market crash? And when is it going to happen? And why isn't it happening? Right? So looking at these figures, I mean, it does surprise me as well, personally speaking, because in spite of everything that's going on, the real estate market has been very resilient. And there's got to be reasons and dynamics for this, which in future episodes of Real Estate Chat, we will talk about. Last but not least, I know this is going to be a bit hard to see on your screen.
Well, it's hard to see. And the only reason is these little boxes, which I did this over the weekend. And so in the last, compared to 2 weeks ago, we have 3.5% more listings. A month ago, we've got 16% more listings. This is inventory. And 2 months change, we have 38% more inventory. So as we saw in that chart earlier of inventory, it is moving up. It is moving up. And sales, you can't really read it if you look down on that, but sales are like at this point in July compared to June, 2,500 less. That was 7,500. So what are we looking for? Between 5,000 and 6,000 for July. It's too early to say, but holiday, long weekend, all that stuff. But the market is going into summer. And in 2 weeks, we'll know more about July.
So there you go. There are your real estate housing market concerns, as the media has said. And if you're looking to make your move, make sure you ask the right question. Make sure you don't just read the headline or the article and not look into what's actually driving these figures, as Robert clearly and very detailed explains. And so if you have any questions, make sure to leave it in the comment section. We'd love to hear from you. If you like this episode, click like. If you don't like it, click dislike and then tell us why in the comments. Make sure you subscribe so that you can watch our next episode of Real Estate Chat when that comes out. Stay tuned and take care. Bye for now.
See you later.